One of the interesting features of ICICI Bank is that it's both an emerging market bank, very representative of the Indian economy, but it's also an ambitious bank. You have opened several fronts in the UK, in Canada, in Russia even. What does your balance sheet look like in terms of the international business that you're trying to build?
You see, in the last 5 years, let me go back a little bit and say why we opened up the global front. It was a very simple strategy. It says that we call it horizons of growth. We were on an early horizon of growth, which was industrial lending. But that came under pressure in the 1990s. So we opened up by becoming a commercial bank, the retail horizon of growth. So that opened up consumer credit to us as the next horizon. But I would say in the last 6-7 years, corporate lending came back very strongly. So it rejuvenated. We then said that we need to look at the next horizon of growth, which is the internationalization of India. Indian business and Indians, both ways. And we said we need to be present where Indian companies go or where Indians are present. And that's how we went to the countries where we were. I would think that the current global situation has meant that we need to look at this opportunity also with a little bit of, I would say, care and context as to what could happen. So this balance sheet today is around 25% of our overall balance sheet. Right. And that's what we have grown to in maybe the last 5 or 6 years.
And that's a significant component.
That's a significant component. And it has given us tremendous, I would say, experience and learnings, as well as comfort in terms of income and balance sheet size, diversification of liabilities and so on over the last 5 years. But at this point in time, it probably is right to just keep that portfolio on idle, not let it grow significantly. The reason being, let the global situation calm down. And it's only then that Indian companies will again think in terms of going out of the country.
Have you reached a point where your global funding capabilities enabling you to do, on the deposit side, right, enabling you to do strategic things with your Indian corporates demand for
In the first 5 years, we used market borrowings to fund growth. And there was a time when market borrowings were very comfortable. Most of our borrowings are long dated, so there is no issue in terms of any challenge there. But what we have been able to do in the last 2 to 3 years is both in Canada, UK and Europe, which is Frankfurt, raise direct deposits from the public. And the way we have gone about it is through the online route. So we have leveraged our ability to use technology, which we built up in India. That strength we leverage in these domains by keeping costs of actually raising the deposits very low.
But still, you competed on price.
We can easily compete on price because our cost of operation is so much lower.
Okay.
And initially, we raised savings money there, and slowly have moved into term money there. And today, in all the 3 domains that I mentioned, Canada, UK, or Germany, we can raise maturities that we want to the extent that we want, so that you have an appropriate liability mix. So we are in that phase. So I think we are in a situation now where we have been able to create the sort of liability flows that we want going forward.
Now, you have one advantage in that your capitalization is still strong, but you're trying to influence, coming back to India, the market you're trying to lower your costs of your funding costs, and then you're trying to match that to the businesses that you want to go into. How does that, that's a moving ship.
It is a one-time correction that we need to do, and I'll explain why it's a one-time correction. Our cost of funding was higher than that of other banks for a very simple reason. When we merged ICICI Limited into ICICI Bank, we had to hold on all the liabilities that ICICI Limited had. We had to now provide for government mandated reserving requirements, particularly in terms of statutory liquidity ratios. So the government paper that we own, we had to buy. So that raised our funding cost. And our branch rollout was also regulated over the last 5 years. But in the last 2 years, we see branch rollout approvals have been much easier than in the past. So we have been able to scale up our branches dramatically. From 700 maybe 2 years back, in the next 2-3 months, we should get to something over 2,000 branches. We are now at over 1,500 branches. So given that distribution ability, we said this is an opportunity now for us to rebalance the liability side. In any case, there was a slowdown on the asset side, or at least we thought that we ought to slow down on the asset side given the conditions. So there was, I would say, a congruence there in terms of the market, what is happening in the market in terms of on the asset market, and at the same time our need to rebalance the liability portfolio. And that's, I think, what executive management is today doing.
What are some of the key themes in the development of the global financial architecture that are personal to you and that will influence the way in which an emerging market bank like ICICI becomes global?
I think a whole lot of learnings have come out of the challenges that arose in the last year or so. I think one major learning there is that probably the era of high leverage is over.
Okay.
And I think we are actually very conservatively leveraged. Today we are leveraged less than 8 times as a bank. So by whatever yardstick you're going to be measured, our leverage is very low. And that translates into very high capital adequacy as far as we are concerned. So message and what we take away from this is that what we have done is right and continue to do what we did.
Now, interesting thing about a bank like ICICI is also not just a question of leverage, it's also your liquidity profile, especially because you have one leg in India and you've got another leg in very developed countries where you are a competitor for deposits.
Yeah, I think, frankly, a few years back we were relying basically on market access. And if we had continued to rely only on market access at this point in time, we would be challenged because market access is dried up. I think our switch to a retail platform 3-4 years back, and now that platform scaling up, has actually removed any constraint that we would have had on the liquidity front. And A and B actually also lowered our cost of funding. I think these are some of the learnings that we have. Diversify your funding mix, run very high capital adequacy, run a low leverage, and I think that's what we will do. If you remember, going back, our strategy was very clear: get the capital right, get the people right, get the technology right, get the product right, get the process right to do business. That's what we will continue to do.